Hey guys, and welcome back to an episode of Money Mindset. Today we're talking about the so exciting topic of pre-approvals. Coleman.
So Stephanie, you told us a lot about the home buying process. You told us about how to get it started, but then you mentioned pre-approval. So for those of us that aren't in the real estate industry or really familiar with that industry at all, can you tell us a little bit about how the pre-approval process works?
Absolutely. So pre-approval, if you haven't seen some of our previous videos, it's just the lender saying that you're go ahead and spend the money, you're backed for it, the bank is going to lend you X amount of money for a house. It's very important because, if you're looking at a home that's $350,000 out there, 150, whatever it is, something that's over what the bank will actually lend you, there's a problem. Unless you've got the cash for it, you need the pre-approval. So how does it work? Great question. It starts by talking to the lender, talking to your bank, having them go ahead and review the documents that they need. So they'll request W-2s, pay stubs, bank statements, driver's license, they'll run your credit, stuff like that. And from there, they'll be able to tell you how much you're pre-approved for.
Great. Well, how does the lender actually calculate this?
So this is something that we get asked on a lot, or I get asked on a lot, because people want to know if their income is going to give them a pre-approval. To back up a little bit, pre-approval is based off something called a debt-to-income ratio. First, we make sure your credit's good as far as, what's your score? Are you, a 700 credit score, 650, wherever you are in the range. Generally, you want to be somewhere at least in the low mid 600s to as high as you can go. And the higher you go, credit works in brackets of 20. So, 620 to 639 is effectively one credit score for interest rates, 640 to 659, up and up in tiers on the ladder. Everything above 740, your top tier, best interest rates, best programs, all that good stuff. That being said, let's swing back to that debt to income ratio. So when we run your credit, we see what monthly payments pop up. Do you have a car payment? Is that, $300, $700 a month, whatever that is? Do you have credit card payments? What's your minimum monthly payment on the credit card? That's what we're going to use to calculate. So if we add all those monthly payments together, and we'll take your student loans into account. Maybe you don't have a student loan payment right now, but you have an outstanding balance. They're in deferment or whatever it is. We're still going to use a certain percentage of that. So take your income. We divide it roughly by half, depending on the loan program, 50%, it can be anywhere, whatever, in the range. Subtract your monthly payments, and whatever money is left over, so let's say we have, $5,000 a month that you guys make, and then we take about half of that, you're at $2,500, you've got $500 a month in monthly payments between your car and minimum credit cards, then you are pre-approved for a home payment up to $2,000 a month, following that equation. Now, that's a very rough general idea of it all, but now you start to get how it works. So, how does the lender get to that $5,000 a month figure? How do they calculate your pre-approval? It depends on your income type. So you have hourly, salary, commission, and then you can have self-employed as well. And they're all going to be calculated a little bit differently. Salary, pretty straightforward. Easy for you to find out how much it is. We're just going to divide that yearly salary by 12 and you have your number. It goes off of gross, not on how much you're taking home, just as a little sidebar there. For hourly, we're going to average out. We're going to see how many hours a week that you work on average. So if you take, if you're averaging 40 hours a week or 35 or whatever it is, that's how we're going to pace it out, and that's how much we're going to use in that calculation. Multiply that by your hourly rate, and we've got it. For commission or anything variable, this includes overtime, this includes bonus income, anything that is varied and not a standard rate amount, we're going to take it to your average. So if you have an hourly or salary amount, but you haven't been with that employer for 2 years, you don't have a history of those bonuses for 2 years, well, we're only going to count the salary, we're not going to count the bonus. And same thing with commission. Sometimes, there's other careers or jobs that you don't think of as commission. Bartenders, restaurant workers. We're going to be looking at your tips as commission. If you haven't been there 2 years, we are only allowed to count the base pay, which most places, that's, $5 a month, an hour. It's below minimum wage, so you're not qualifying for much. Now, there are a bunch of other sidebar rules, and always ask your lender, and we can get into your specific situation and answer your question. These are just general overviews of this topic. Self-employed is going to be a little bit more intensive, but it's not too difficult. You can just go ahead and submit your past couple years of tax returns. If you have a separate personal and business tax return, submit both of them, and then we'll just want to see how that business is tracking. So profit and loss statement year to date, some business bank statements just to see kind of how it's pacing and show evidence that the profit and loss that you're putting together, which is just a sheet kind of showing where that business is tracking for the year, is lining up with reality. So that's it.
Well, what about the people? I know a lot of people have actually started new businesses recently. So for those people that, let's say, year 2020 was the first year of their business, what does that look like for them?
And that reminds me too to touch on 1099 is still considered self-employment. So a lot of people, they're starting new businesses, they're starting 1099 income. It's the same thing. Let's say that you started, let's say August 2020 of a new job new job at 1099 or as a self-employed. We're gonna wait until you have 2 full years of business tax returns. So whether that's your personal tax returns that you're putting that business that you're creating on, or an actual business tax return. So you start in August 2020, well, now we have to have all of 2021, all of 2022. You file 2022 in 2023. So now we're quite a bit off on it. So that one is the longest type, and it's something that we have a lot of co-signers for. There's other things that we can do to help qualify you for a home. If you have, other people that are willing to use their income in order just to get the pre-approval on the loan or to get the loan in general, you can always refinance them off later. That's all topics for another time, but that is how it works.
All right, well, thanks for sharing that. Well, thank you guys again for watching and spending some time with Stephanie and I. Please hit the subscribe button below and also leave your comments because we do want to know what topics are most important to you.